everyone, welcome to the channel. Today I'm breaking down a popular and powerful way to invest mutual funds. What are they? How do they work? Are they right for you? Stick around because by the end of this video, you'll know exactly how they can fit into your investment game plan. So, what exactly is a mutual fund? Think of it like a big basket of investments. It pools money from lots of investors to buy a diversified mix of stocks, bonds, or other assets, all managed by a professional fund manager. Let's say you and 1,000 other people each invest $1,000. That's a total of $1 million. A fund manager then uses that money to buy a variety of investments like Apple, Google, government bonds, and more, spreading the risk. Now, why use a mutual fund? Here's why mutual funds are so popular. Diversification. Your money is spread across dozens or even hundreds of companies. Professional management. A fund manager does the research and trading for you. Accessibility. You can start investing with just a few $100s. Now let's talk about the types. Not all mutual funds are the same. Here are the main categories. Equity funds. These invest in stocks and come with higher risk but also higher return potential. Example, Vanguard Total Stock Market Fund, VTSMX, bond funds. These invest in government or corporate bonds, offering more stable income. Example, Fidelity, U.S. Bond Index Fund, FXNAX, balanced funds. These mix stocks and bonds for a balanced approach. Index funds. They track a specific index like the S&P 500. Example, Schwab S&P 500 Index Fund, SWPX. Money market funds. These are low-risk, short-term investments great for parking cash. So how do you make money with mutual funds? There are three main ways. Capital gains. If the fund sells investments for a profit. Dividends. If the companies in the fund pay out profits. NAV growth. The net asset value or share price of the fund increases over time. But there are a few things to watch out for. Fees. Some funds charge high management fees, known as expense ratios. Look for low-cost options, especially index funds. Taxes. Even if you don't sell, mutual funds may generate taxable events like capital gains. Liquidity. Unlike stocks, mutual funds only trade once per day at market close. So, who should consider mutual funds? If you're a beginner or someone who wants a hands-off investing approach, mutual funds are a great option. You get instant diversification and professional management, even if you're not a market expert. Let's say you invest $5,000 in a mutual fund that holds 100 different companies. If the market grows 10% in a year, your fund could also grow, and you'd have about $5,500. And you didn't have to pick a single stock yourself. Mutual funds are one of the easiest ways to build long-term wealth, especially if you're just starting out. If you want low-effort, diversified investing, this might be your perfect match. If you found this helpful, hit that like button, subscribe for more simple investing content, and drop your mutual fund questions in the comments below. Thanks for watching, and happy investing!